Sumit Podar is now joining us from Tikona Capital. Sumit, thanks for taking out time for us. Are you a fan of any of these, companies like Mirza International, Footwear, Metro, which have done well? Anything that comes to your mind? Or Railway Capex? I think that is something which you have spoken about earlier. That's also doing well for last 4 days.
Right, right. Hi, Pankaj. Thanks for inviting me to your show. And yes, what's happening is definitely these areas where either the spends are kind of quite strong or expectation of spends coming back or consumer spends coming back is what is driving these stocks up. Also, during March, I'm sure we all saw most of the stocks getting hammered, and possibly things are coming back on that side, and which is why, as you mentioned, some of the footwear stocks are back with raw material prices going down, and possibly even the interest or the inflation kind of moving down will help all these consumer discretionary stocks going forward, which is what is kind of giving this positive flip to these stocks as such. So we may see a follow through. It's starting from footwear, possibly other consumer discretionary spends would also start seeing things coming back gradually, if not immediately. Of course, because most of the consumers have got impacted severely because of the inflation, and which is what is likely to kind of turn back. Or we are already seeing that inflation is coming down at a drastic rate. Crude has fallen, most of commodity cost has fallen, supply chain cost itself has kind of come down. So we will see these things coming back. And as you rightly said, within capex, of course, the railway capex is what is the strongest as far as the overall state capex as well as central capex is concerned, which is what is driving these stocks up.
Sumit, good afternoon, and this is Winnie joining in the conversation as well. Sumit, one thing I want to talk about is IT. You had spoken about it first that, to stay away from IT, you were not looking at it, you were expecting a downfall, and now we have seen that correction coming in. All the stocks have seen a sharp correction. Is it time to revisit this, or is it still some time that we stay away from this, wait for some more correction?
Yeah, hi Vinny, thanks for this question. Of course, I have been a long timer as far as IT is concerned. If we look at what is happening with the sector is primarily this is driven by the slowdown as far as the developed world is concerned. While the world was kind of slowing, the spends were expected to come down after a very good year in FY22. The growth was expected to moderate, but what happened is primarily because of the banking crisis, we saw a lot of clients kind of taking back their spends or maybe taking a wait and watch kind of an approach to ensure that if any knee jerk or any larger impact as far as the overall macroeconomic situation is concerned, if takes place, then they are much more cautious, and which is what actually impacted the results of many of these large cap. But as we are seeing, it's up. I mean, the small or mid cap, as far as IT services are concerned, is likely to, or at least showing a better traction. So yes, there is a pain of 1 or 2 quarters. We could see them bottoming out within a couple of quarters or maybe mid of this particular year. Because we should not forget that these companies are still generating high ROCs of 50 to 60%. They will be kind of sharing cash. They will rather be throwing good amount of dividend and buybacks. Similarly, if we look at, we all are talking about Chat GPT or AI ML. While it is simplifying the technology for you and me, but at the same time, it is making the life of the enterprises much complex, because what they have to do is they have to run their current system as well as build upon that particular system. So rather the technology from enterprise view is getting complex, and in order to solve those complexities, they need to have IT services players into place. While the one section of markets is expecting that AI or Chat GPT is rather going to be kind of a dramatically shifting the growth rates of these IT services companies. But in our view, possibly we could see enterprises rather seeing complexity going up, and if the complexities are going up, they would rather need an external vendor to solve or fix their problems in conjunction with their existing systems. So once all these issues as far as macroeconomic issues are concerned, we could see spends coming back from these larger enterprises. But nonetheless, I mean, having said that, possibly from an investor standpoint, the domestic economy is looking much better than the global economy spends, and possibly there are much better ideas on the domestic front compared to IT sector. While at the same time, we could expect things coming back by end of this year or mid to end of this year as far as IT sector is concerned.
Maybe a quarter or two you would wait and watch. Okay, you recently wrote, in your newsletter that, India seems to be at an inflection point. And when I read that particularly and, carefully, it's mainly talking about inflection points of healthy earning in the second half. So can you just talk to us about your thesis that why do you believe FY24 earnings can be better than what the street is estimating?
So, Pankaj, a very intriguing point that you brought into picture. So, let's kind of step back and see what has happened in the last 12 to 18 months. If you look at last 12 to 18 months, it is largely the inflation-driven thought process that is going on the participants of market. It is largely that inflation, runaway inflation was there. On top of it, high interest rates. I mean, 475 basis points kind of increase as far as US is concerned, 250 basis points as far as India is concerned. So we have seen a rapid rise in interest rates, while inflation is definitely dramatically coming down, and which is what gives comfort as far as the inflation or rather interest rates could be stabilized. Now, the million-dollar question is when the interest rates are likely to be cut, which is what the market is waiting for. In addition to that, what is happening is the world is relatively slowing. But in this world, possibly India offers a kind of a green shoot where we offer a very healthy, sustainable growth. So let's again step back how the government or how Indian institutions, large institutions, including RBI, the India tech stack, or even central and state government as well. What have they done in the last, let's say, post-COVID era? We have rather, in every adversity, we have been an anti-fragile institution, rather it be on health side. Take the case of oil crisis. We again turned that down into an opportunity, rather it being a threat, because if we are 80% dependent on outside oil, rather our economy should have kind of got crunched, and the consumers of this country should be bearing the brunt of inflation. So similarly, on the banking crisis, we have thwarted that primarily given the fact that the balance sheets of banks, governments, individuals and corporates, all of them are in a very healthy shape. Rather, in the last two crises, Indians and Indian government and institutions have rather become much stronger. So coming to the point, yes, first two quarters are a bit challenging. Towards the end of this particular year, we could see a very good earning growth rate coming back. That is on the back of the fact that most of the corporates who are going to spend appropriately are going to see a very healthy growth rate. So just to give an example, take the case of ICICI Bank, which invested well in technology. So we are seeing that growth being much stronger as compared to sector for them. So similarly, every sector would see those technology investments coming back, and which is why we believe that second half of the year could be an inflection point, and this is not going to be a one-off growth. Possibly we are going to see a long-term sustainable growth as far as the India and Indian companies are concerned.